Imagine running a business where you only record transactions when cash changes hands. It sounds simple, but what if your company completes a $100,000 project today and doesn't receive payment until next month? Or what if you receive a utility bill next month for electricity your business used this month? If you only track cash, your financial statements wouldn't tell the true story of what happened during the period. And that's where accrual accounting and the matching principle come into play. These concepts ensure that revenues are recorded when they're earned, and expenses are recorded in the same period as the revenues they help generate, not necessarily when cash is received or paid. In this video, we'll break down these fundamental accounting concepts and see how they help businesses produce more accurate and meaningful financial statements. One of the core principles of accounting is the accrual basis, which ensures that expenses are matched with the revenue they help generate. This is in contrast to the cash basis, where transactions are recorded only when cash changes hands. While the cash basis may seem simpler, it can distort financial results by making a business appear more or less profitable than it actually is. How come? Because the business owner could manipulate when expenses are paid or cash for revenue is received. There's a lot of room for financial manipulation. Under the matching principle, revenue is recognized when earned, not necessarily when cash is received. For example, in a cash sale, revenue is recorded immediately. But if a company provides a service today and invoices the client for payment next month, the revenue is recorded now because that's when it was earned. Some industries like software and subscription services follow complex revenue recognition rules to ensure compliance. And the same concepts apply to expenses, which are recorded when incurred, not necessarily when cash is paid. If a company uses electricity in December but doesn't receive the bill until January, the expense still belongs into December because that's when the electricity was used to generate revenue. Accountants spend significant time ensuring that revenue and expenses are properly recorded. This is especially important in industries with long-term contracts, subscriptions, or complex sales structures where improper recognition can lead to misleading financial statements. Adhering to the accrual method and matching principle ensures that financial reporting accurately reflects the company's performance, and providing investors and stakeholders with a true picture of profitability. As I just mentioned, revenue recognition is a critical process for businesses, especially in industries like software, subscriptions, and services, where determining when to recognize revenue isn't always straightforward. Take a software license, for example. You pay at the beginning of the contract period, but the company doesn't recognize all that revenue up front. Instead, it's recorded gradually as the contract period slowly expires. To ensure consistency and compliance, businesses follow a 5-step model for revenue recognition. 1, determine whether a contract exists. 2, identify performance obligations. 3, determine the transaction price. 4, allocate the transaction price. And 5, recognize revenue as obligations are met. These steps might sound simple, but the process is anything but simple. I've worked for a large software company, and it had a separate accounting team that just worked on revenue recognition, the related policies, and audit documentation. Matching expenses to the revenue they help generate is a key part of accurate financial reporting. During the month-end close, accountants ensure that all expenses are properly recorded, even when the invoices haven't arrived or exact amounts are uncertain. One challenge is accruing expenses when the exact cost isn't known. For example, if a company is facing a potential lawsuit, accountants work with the legal team to determine if a settlement is likely. If the estimated range is $10,000 to $50,000, the company typically records the lowest probable amount, in this case $10,000, to ensure financial statements remain accurate without overstating liabilities. Another complex area is prepaid expenses, which must be recognized in the correct period. If a company pays upfront for a year of insurance, it doesn't record the full expense immediately. It's spread out over the coverage period. In industries like insurance, actuaries and accountants estimate expenses using mathematical models. For example, health insurance companies don't know the exact amount of claims that will be submitted in a given month. So they rely on historical data and statistical models to record an estimated liability. Accuracy is critical here. A small miscalculation in an Excel model could lead to significant financial misstatements. By properly accruing expenses and recognizing them in the right periods, businesses ensure their financials reflect reality, giving stakeholders a clear and accurate picture of profitability. The matching principle is one of the foundations of accrual accounting. By recognizing revenues when they're earned and matching the related expenses to the same accounting period, businesses provide a more complete and accurate picture of their financial performance. Throughout the rest of this chapter, you'll see this principle in action as we record adjusting entries for accrued expenses, accrued revenues, deferred revenues, and deferred expenses. Once you understand the matching principle, those adjusting entries become much easier to understand because you'll recognize they all serve the same purpose, ensuring that financial statements tell the true financial story of the business.